Hello and welcome to Compass Global Markets Weekly Update. I'm Tony Boyajian. We're going to kickstart by talking about risk sentiment and geopolitical risk, which has been the headlines now for the past few days. We've seen that risk sentiment ease a little bit overnight on the back of US military officials understating, if you like, risks of an imminent attack on the Korean Peninsula. We've seen a relief rally in the US dollar, nothing more, nothing less, just a relief rally, but it could be short-lived because it could be the calm before the storm. Geopolitical headlines still rule the roost. The volatility index, the VIX, which is a measure of the amount of fear in financial markets, fell 20% overnight on this miraculous relief rally after reaching 9-month highs. So watch this space for any elevation in terms of geopolitics. Now, safe haven currencies, these are the currencies that enjoy a current account surplus, like the Swiss franc, the Japanese yen, and even the euro. Well, they've all retreated. They've drifted a little bit lower overnight. However, they will be remaining well supported, especially if geopolitical risk heightens. Now, overnight we saw the euro and the yen weaken a little bit. They fell by 0.5% and 0.7% respectively against the US dollar. Yesterday we saw some economic figures out of Japan. Second quarter GDP numbers rose by 1%. Now this was a lot stronger than expected on the back of some strong consumer and business spending figures. Now GDP in Japan has grown to a 4% annualized level, where the forecast was for it to rise by only 2.5%. It's the fastest pace of growth in Japan for 2 years. So the yen will continue to be driven by this geopolitical uncertainty in the Korean Peninsula. We expect the US yen exchange rate to hold around the 108 level as support on the downside. We could see Aussie yen drift lower towards 85 level in coming days. Elsewhere, weak US inflation continues to be the headline when we look at US economic data. Core CPI in America is only 1.7% per annum. It's well below the Fed's target of 2%, and that's been the case now for a number of years. It reduces the probability of another interest rate rise in the US from 45% last week to 35% this week, and this is for another rise in December this year. So when we look at the US economic numbers, jobs growth has been quite robust, but inflation remains soft, and the market will await Thursday's FOMC meeting minutes to ascertain more information on the inflation outlook. Now, China's economic activity continues to grow, although a little bit weaker than expected. Yesterday we saw China's retail sales, industrial production and fixed asset investment figures come through quite healthy, good solid rises across the board. However, they were a little bit weaker than expected. A lot of people are saying that's the reason why the Australian dollar has fallen by 0.6%. But in reality, that fall is not really a deterioration in Chinese economic growth. It's just a weaker number than expected. We generally see the Aussie dollar pull back when there's heightened risk aversion in the market. So we believe the Australian dollar will remain confined in the 77.5 to 80.5 US cent range for the time being, and the Australian dollar outlook, as I said, tends to retrace lower when risk sentiment rises. Now, we've just seen today minutes of the RBA's statement of monetary policy for the month of August. They've maintained their GDP growth target of 3%. They continue to call the Australian dollar lower. Their preference is to see a weaker Australian dollar, and that's why we believe the Australian dollar will stay in the 77.5 to 80.5 cent range. Low inflation means low interest rates. Their policy hasn't changed, and we believe rates will remain on hold at record lows of 1.5% for the next 12 months. The euro is still around 2.5-year highs, and elsewhere the only other big news in Asian markets, I must say, is the Philippine peso. The Philippine currency is Asia's worst performing currency. It's down by 10% in the past 12 months. It's fallen by 2.5% just in the past few weeks. And it looks like they're going to record a current account deficit for the first time in 15 years, hence the reason why the Philippine peso is quite weak. So a really good opportunity to buy Philippine peso for any importer out there that needs to make payments into the Philippines. Thank you for watching. I'm Tony Boyajian, Compass Global Markets.